Hi everyone, so welcome to the stream today. Really excited for having you on another episode as we continue with our discussion for the July 2026 ICAG examination. On the episode today, we're going to be focusing on financial reporting, corporate reporting, and public sector accounting and finance, giving you a breakdown of the syllabus, the key issues that you have to focus on, and most importantly, how the topics are knitted together to ensure that you optimize your chances of understanding each of the key areas in each of these subjects, and most importantly, put you in the position to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. And so, welcome, and we are going to be looking at some few things here, and then we will see how far we can go as we continue with the discussion. Give me a sec quickly. Let's see if I can pull this up quickly. Let's go here. All right, so let's go. So finally, the results has been released for the March 2026 examination, and I believe that you have checked your results. If you have not yet, you can look at it, and I believe that it went well for you. I mean, we've had some people sending us messages about that, and we are still waiting on putting all the pieces together, but we hope that it is going well for you. Now, whatever be the case, as we say always when it comes to the examination, yes, there are sometimes you're going to win, sometimes you're going to lose. It happens like that. Yes, there are some people who have now become chartered accountants, were really excited about it. Yes, some people registered for two papers, passed all. Some people registered for two papers, passed one and failed one. Some people also couldn't pass the papers that they registered for, maybe a paper or two papers. Wherever you are at, especially if you failed a paper or you couldn't pass the exam, what you need to do is to rethink, re-strategize, and go at it again for the July 2026 examination. And it's kind of a little exhausting if you look at it in that manner that, hey, listen, I put in the work, I put in the effort, but, I still fail the examination. Yeah, it happens sometime. So what you're going to do is to just put yourself in the position to go into July 2025 and July 2026. And you want to make sure that you are not giving up and you're not becoming complacent, because sometimes what happens is that when people fail the exam, they realize that, okay, maybe you got 35, maybe you got 42, and you're like, oh, I was left with just 8 marks to go. The truth of the matter is that you're not left with 8 marks to go, because it's not a continuous marking scheme. It is, you are starting from scratch. So it means that something didn't go well in the previous examination date. So you have to sit down, reflect on whatever you have done, reflect on the experience that you have had, and most importantly, find out what is it that you can do to change your story going into the next examination date. And so for all of you who couldn't pass the examination, or you failed a paper or so, it's okay. Just re-strategize and put yourself in a position so that you can go in July stronger and pass the examination, because that is very important at the end of the day, to be able to be in the position to pass the exam. So let's go straight up into the discussion. As I mentioned, we're going to be focusing on financial reporting, corporate reporting, and then public sector accounting and finance. We're going to be getting a breakdown of the syllabus, the key issues that you have to focus on. And so this is going to be a well-packed session, and you want to make sure you have your notepad, your notebook there to be able to be taking notes. Then if there are any questions you have for me also, don't hesitate to put it in the comment section or the chat box for me. Those of you who are joining us on Microsoft Teams as well, you can raise your hand, I'll bring you up, or you put it in the chat for me, certainly, and I'll be able to provide you with the answers to any questions that you are having. So let me bring up my screen real quick, and then boom, let's get excited into the discussion here. So let's go first on the journey of financial reporting and corporate reporting. Okay, let's go on the journey of these two papers first: financial reporting and then corporate reporting. So in the previous session, that was yesterday, in case you missed that, you can check the description of this video on YouTube and you'll be able to watch it, or you can check the channel page. It is in the same playlist here and you'll be able to watch it. And so if you remember, we mentioned that there are a couple of things we must understand when it comes to financial reporting and corporate reporting. Now, let me tell you a few things about it and crystallize some of the principles quickly, then we go. Number one, as we mentioned, the financial reporting, corporate reporting is dependent on the accounting standards, so the IFRSs. And so if you want to pass financial reporting, corporate reporting, you must understand the accounting standards. There is no option here. There is no, okay, I'm going to try and see. No, you got to understand the accounting standards. Number two is that to be able to pass this examination when it comes to financial reporting and corporate reporting, you must understand the average pass rate. The average pass rate for financial reporting, corporate reporting is between 30 and 40%. That's the average pass rate, generally, okay, for the overall ICAG, generally 30 to 40%. What does that mean? It means that on the average, only 4 out of 10 people pass the financial reporting, corporate reporting examination. So the average pass mark is very skewed, minimum. And so what it means then is that it is important you identify what makes people fail the paper, then you can position yourself to be able to pass the examination at the end of the day. And we're going to be going through that in a moment as we build the story up. So just stay with me here. But that is the second thing. The average pass rate is very low. So it means if you are going to pass this examination, financial reporting, corporate reporting, you need to work extra hard. You need to go the extra mile. You need to make sure that you really put yourself in the position to pass the examination. So the first thing, the accounting standards. Number two, the average pass rate, 30 to 40%. Number three is the fact that we are going to be having theory questions here. As we mentioned in the previous session, 20 marks theory questions are going to be coming up. But then the issue here is that many students ignore this. And so they forget that, oh, in financial reporting, corporate reporting, 20 marks of the questions will be theory. Written question, like done deal, waiting for you in the exam hall. And these theory questions will be covering sustainability, integrated reporting, ethical issues, the accounting standards, conceptual framework and regulatory framework, and some other few issues, governance, corporate governance. These are some of the theory areas that is going to be covering up for the 20 marks. So you must understand as a financial reporting or corporate reporting student that the examiner is going to be bringing 20 marks questions standalone in the exam hall for financial reporting and corporate reporting, and you should be in the position to be able to understand that very well and answer the question in the manner that it's supposed to be answered. So number one, IFRS masterclass. Number two, the average pass rate, very low. So you have to work hard to be able to pass the examination. Number three is the fact that there is a written question in the exam hall making up of 20%. So as you are studying, you have to be mindful of that 20%. It's very easy to take it out as quickly as possible to put yourself in a position to pass the examination on the overall at the end of the day. Number four is to understand that questions are going to be based on application of your knowledge. Okay, so the questions are structured to apply your knowledge to specialized scenarios. Specialized scenarios. So the quality of the question is really like it's the best of the best. If you don't study, if you study haphazardly, if you're not somebody who is conscious, you will go to the exam hall, you will see the question part, you will realize that, oh, this is IAS 38. I can see this is IFRS 15, but the structuring of the question can swallow you. You can see that, this is this particular accounting standard at play here, but you may not be able to answer it. So you must understand that the examination is about application of the principles. So it is not just about, you You understand IAS 16. You understand IAS 38. You understand IFRS 2. You understand IFRS 15. You understand IFRS 9. Yeah, you can understand it. The question is, can you apply it based on the context of the question? And that is the fourth thing you must understand, because your exam is going to be a scenario-based examination, which will call on you to apply the principles to specific questions in the exam hall. So as you are learning, as we are beginning this journey and going through this discussion, you must ask yourself, am I getting the principles? Okay, am I able to apply the principles to specific questions, specific scenarios? Is that helping me enough to put myself in the position to go into the exam hall, write the exam with confidence, and pass the examination? That is the fourth thing you must understand if you want to pass this exam. So again, number one, IFRS masterclass. Number two, average pass rate here, 30-40%. Number three, we are going to be having a theory 20 marks question there. Number four, the examination is based on application of your knowledge. Number five is this time. In the exam hall, time is going to be your enemy, because the examination is a 3-hour paper. Okay, 3 hours. That's all. And that's all. So within that 3 hours, you should be able to optimize yourself to pass the examination. And so you don't wait till that examination date when you are in the exam hall before you start looking for speed and accuracy. You cannot wait till that day before you say, Charlie, how can I move fast? How can I punch my calculator fast? No. Over the next 12 weeks, as we are studying, as we are going through the discussion, as you are doing your personal studies based on your study plan, you must work with speed and accuracy. Because time is going to take life out of you in the exam hall. So how do you prepare yourself to be urgent? How do you prepare yourself not to spend significant amount of time on a given question? Because you see, sometimes people fail the exam, not because they don't know, but it's because they were caught up with time. Maybe by the time the examiner says, or the invigilator says, get ready to stop work, you've answered only 3 questions. 3 questions. And by the time they say stop work, that's all. 3 questions. 3 questions, it means you are going to be marked over 60. Okay? Chances are the 3 questions you've answered, not all of them are even correct. So sometimes people fail the exam, not because they don't understand corporate reporting, they don't understand financial reporting, but it's just because the 3 hours in the exam hall was not enough for them to answer or attempt as many questions as possible. So in order not for us to suffer that fate in the exam hall, where get ready to stop work, you've answered only 3 questions. Stop work, you've done only 3 questions, and you know you are going to fail. There are most of the time people leave the exam hall and you know you fail the exam. You know. Because, you've screwed up. You didn't answer as many questions as possible. And then you wrote a lot of insemhunu as well in the book or in your answer booklet. And so time is important. So in the next 12 weeks, as I mentioned, as you are studying, you need to bear in mind how you can work with speed and accuracy. And this is why I mentioned yesterday that if you are going to be on the live call, you are going to be watching playback, you are going to be part of the lessons, you must be active. If questions are being solved, you must be active. Punching alongside. Assignments are given, do it under time. When you are solving questions on your own, do it under time. When you do this over the next 12 weeks, you are training your brain to be able to think faster, to be able to move with speed and accuracy, and to put you in the position so you can optimize this 3 hours. So that by the time the invigilators say, oh, get ready to stop work, at least you've answered 4 questions and you are on your final question. That will put you in a better position to pass the examination than if you had limited time. So for starters, to pass this examination, IFRS masterclass, you must understand the accounting standards. Note that the average pass rate is just between 30 to 40%. Why? Because of the quality of the examination. Note that we are going to be having 20 marks theory questions in the exam hall. And so make sure you put yourself in that position where you're able to answer that questions or those questions. Then you're going to be having application of the knowledge because the questions are going to be scenario based. And then the fifth thing is going to be time. If there is anything I'm going to really highlight that you need to be mindful of, it will be that fifth point, time. Because as I said, many people fail the exam, not because they don't know, but it's because they couldn't work within the time required. That's all. So if you cannot work within the time required, what happens? It means you're going to fail the exam. You're going to fail the exam. So that is a starting point. That is the introductory discussion that I want you to have as a base for us as we go into the broader discussion for financial reporting and then corporate reporting. So now that we've gotten that out of the way, let me go back here and then pick these things as we expand on them real quick. So let me copy this. So this is our syllable structure. We've mentioned this already, so I'm going to be expanding on this. So make sure you stay with me carefully. We are going to be looking at regulatory framework and conceptual framework, ethical issues, 15 marks. Then application of accounting standards, 25 marks or 25%. Interpretation of financial statement, what you would refer to as ratio analysis. Single entity financial statement, that is in two folds. Preparation of statement of profit or loss and statement of financial position or cash flow statement. One of them will be in the exam hall. Then the last thing is going to be question 1, which is going to be consolidated financial statement. All right? So now let's expand on these discussions briefly as we get excited into our discussion today. I see some of you guys joining. If there are any questions, you put it in the comment section or the chat for me in respect of that. Those of you who are on Microsoft Teams with me, you can raise your hand, I bring you up, or you put it in the chat still for me in the discussion. So let's start with the lion's share area, and that is going to be the IFRS. You see, studying the accounting standards require a certain strategy, a certain technique. If you understand the strategy and the techniques well, it helps you to really understand the accounting standards. Please note, about 90% of the accounting standards are interconnected with each other. Or in other words, they are intertwined. And so we are not going to be doing island issues. What does that mean? You cannot say, oh, I have finished learning IAS 16. Oh, Charlie, IAS 16, there, Allah will lie. Hey, I finished learning IFRS 15. Oh, Because each of the standards will find themselves in other standards. And what I mentioned here in point number 4, that the questions are going to be scenario-based. There are sometimes to solve a question, you must call on 2 or 3 different accounting standards to be able to solve one question, which is 5 marks or 7 marks. So you must call on 2 or 3 accounting standards to solve one question. So the standards are intertwined. Over 90% of them are intertwined. They are not isolated. And that is the same mindset you must have as we approach the accounting standards. That we are not going to be doing anything like, oh, Charlie, this standard there, I'm done. No. Can you deal with it if it is embedded in this standard? If it is embedded in another standard? If it is embedded in that standard, can you still deal with it? that is where your intellectual capacity comes in. What does that mean? It means that you're not going to be doing washing your hand and then throwing away. In other words, oh, I finished doing IAS 36, so then you say, oh, I'm done. Throw it away. No, because IAS 36 can come up in various other accounting standards to put you in the position to pass the examination. So everything is intertwined. So you're going to hold on knowledge and apply the knowledge across board. To start with our accounting standards masterclass, we're going to open up the discussion first with the non-current asset issues generally. And so we will start with IAS 16, property, plant, and equipment. IAS 16, property, plant, and equipment. This is an accounting standard used to account for owner-occupied non-current assets. Now, when we say owner-occupied non-current asset, it means that these non-current assets are used by the business in the day-to-day running of the organization. It means that maybe the asset is used as a warehouse, their head office, showroom, delivery van, vehicles they use, furniture. The things that the entity is using in the day-to-day running of the organization are accounted for in accordance with IAS 16, property, plant, and equipment. Now, here is the trick. Anytime you pick accounting standards, there are a couple of things that you must understand. So, key issues about standards. The first one is the objective of the standard. So, what are the objectives of the accounting standards? And every accounting standard has its own objectives. So, as a student, when you are learning the standards, you should be able to know what the objectives are. Number two, almost every standard will have some key terminologies that you would have to define. So key definitions or terminologies that you must know about. Number three, the accounting standards are going to be having what we call the initial measurement and recognition. Number four is subsequent measurement. And then number five, disclosure. So whatever accounting standard you pick, these are the five issues. Now stay with me carefully here. The objectives, key definitions, and disclosure issues forms part of the theory questions that the examiner can ask you. Remember I told you that there will be a theory question, 20 marks theory question in the exam hall. And that theory can also be an accounting standard related theory. So that accounting standard related theory that the examiner can bring can be a disclosure issue, can be a key terminology issue, or can be an objective issue in respect of the particular accounting standard under review. Then the calculation aspects of the standards that the examiner will bring will center around the number 3 and number 4, the initial measurement and recognition, and then subsequent measurement. So whatever accounting standard you pick, these 5 things, you must know them off head. And that's why I mentioned in the previous session that you must make sure you have a diary, you have a notebook where you consciously document everything if you say you are going to really pass this examination in record time. But these are the 5 things we must understand when we pick each accounting standard. For the purpose of my presentation tonight, I'm going to be focusing on number 3 and number 4 because in the main discussions of the standards, we're going to be running through all of the 5 for each of the standards that we pick as we proceed in the discussion. But I'm going to be focusing on the number 3 and the number 4. So when we pick IAS 16 property, plant, and equipment, we will divide it into 2. Initial measurement and then subsequent measurement. Initial measurement and then subsequent measurement. Now, when we say measurement in accounting, it simply refers to the determination of the monetary value the monetary value of an item or transaction. Recognition is the incorporation of an item in the financial statement. So, how much cost did we incur in buying the delivery van? That is the measurement. How do we record the delivery van in our books? That is recognition. So, as an accounting student, these are KG2 issues you must know about: measurement and recognition. Now, when we pick IAS 16, when it comes to the initial measurement of IAS 16, the standard is simple. The standard states that the initial cost of an asset shall be the purchases cost or the construction cost plus all other directly attributable costs incurred in bringing the asset to its present use. Note that that initial measurement concept applies to various other accounting standards like IAS 38, IAS 40, okay, and some other accounting standards that we'll get into later. So when it comes to, okay, what is the initial cost of an asset? The initial cost of an asset shall be the purchases or the construction cost plus all other directly attributable costs incurred in bringing the asset to its present use. And so in the initial measurement of an asset, there are a number of accounting standards that we must be mindful of. The first one here is IAS 37, provisions. Because in provisions, when we are dealing with provisions, contingent liabilities, contingent asset, where the entity is going to be incurring some environmental cost in respect of an asset that they have bought, when it is due for dismantling or restoration, then IAS 37 requires that we discount that cost into present terms and include that cost in the initial measurement of the asset. Not only that, in the initial measurement, we can call on IAS 23, which is borrowing cost. The rule is simple. Normally, when an entity borrows money to fund the day-to-day running of the organization, it will come in the profit or loss account as part of finance cost. That's the normal thing. However, where the entity borrows the money to fund the acquisition, construction, or building of a qualifying asset, then the interest component relating to the period where there was active work on the construction must be included in the initial cost of the asset. So let me give you an example. This is what we mean here. The entity goes to borrow money, and they're just using it to fund their working capital. Okay, that's no problem. The interest on that loan will come in the P&L account as part of finance cost. Number two, the entity borrows the money, and they are using it to construct their head office. Okay, the general rule is that if the head office took 18 months to be completed, then that 18 months interest relating to the loan that they took to fund the construction of the head office will not be brought into the P&L account, but instead will be included in the initial cost of the head office. That is where IAS 23 comes in, borrowing cost. Then we can call on another accounting standard here, and that is IAS 20, government grant. Now, this is accounting for government grant and disclosure of government assistance. When an entity makes a capital investment and government gives them something in return. So, for instance, the government says, hey, listen, we want to industrialize, we want to create a lot of jobs. So any factory, any investor at all that will go and open a factory in a certain districts of the country, you will get $2 million or you get $100,000. That is a government grant. And so government grant, there are two ways we can account for it. We can use the deferred income approach. We can use the right-of approach. In the usage of the right-of approach, it will influence the initial measurement of the asset. Then we can bring in IAS 19, employee benefit. Normally, when you pay wages and salary to your employees, what do? It comes in the P&L account as part of administrative expenses. That's all. However, if the employee payment or pension that you are given relates to the construction or manufacturing of an asset, then you don't take that pension or salary into P&L account. Instead, it must be included in the initial cost of the asset. Do you get a story here? So the employees who work for our company, their wages and salaries will go to P&L account. No problem on that. But if some of those employees were taken to work on a building that we are constructing and they work there, we pay them every month. Like the same example earlier, 18 months for our head office. And they worked there exclusively for 18 months. Then that salary for 18 months will not be brought into the P&L account. Instead, it will be capitalized and included in the initial cost of the asset. That is IAS 19, employee benefits. So I'm just getting started. Okay, I'm just getting started. But you see where I'm going. So you realize that, you are looking at IAS 16, property, plant, and equipment. But the question is going to be a scenario-based question. And the examiner can weave the scenario anyway, anyhow he wants. And if that scenario he is weaving relates to initial measurement and recognition, then these accounting standards may follow you in that scenario. And so your ability to be able to put the standards and apply the principles to the scenario in the initial measurement is crucial to be able to pass the examination. And that is what you must understand here. And so that is just a freestyle initial measurement for you to understand there. So again, what did we say? The initial cost of an asset shall be the purchaser's cost plus all other directly attributable costs incurred in bringing the asset to its present use. That is initial measurement. So anytime you are doing initial measurement of an asset, some of these accounting standards may have to follow you there. It's not me who is saying it. That is the standard. Sometimes we can even bring in IAS 2, inventories. Again, we are constructing our head office. It's going to take 18 months. Okay, we have inventory of cements or our own inventory that we are going to be using. So maybe we sell cement. So we're going to take some of the cements that we sell to build that particular warehouse. Okay. Because we didn't sell the cement, the cost of the cement cannot be included in cost of sales in P&L. Instead, the cost of the cement, lower of costs and net realizable value, will be included in the initial cost of the building. So IAS 2 inventories can follow us here. So 5 accounting standards connecting us to just initial measurement, IAS 16, property, plant, and equipment. So if you tell me that, Nhyira, I understand IAS 16, my question then will be, have you solved questions in IAS 16 where these accounting standards are there? And are you able to treat them in the manner they are supposed to be treated in their original principle and in IAS 16, property, plant, and equipment? That is where you reach and you say, yeah, I understand the accounting standards. And it's interesting because if you see the accounting standards this way, then you realize that, oh, it's intertwined. So it's not isolated. So if it is not isolated, then I'm not learning a lot of accounting standards because they are intertwined. So I'm just learning one thing separated in different entities or distinct elements, but they are all integrated. That is the beauty of the standards. So let me go next to subsequent measurement. So after the initial measurement, we go to subsequent measurement. Subsequent measurement is what happens after the asset is ready for its intended use. What do we do from there? Now that the asset is ready for its intended use, what do we do? That is subsequent measurement. IAS 16 says that on the subsequent measurement, the entity can account for the asset either at the cost model or the revaluation model. Okay, so cost model or revaluation model. That's okay. But it means that we will go back and then look at some key terminologies here under subsequent measurement when it comes to PPE. And those terminologies here will include things like depreciation. So what is depreciation? What is amortization? What is impairment? And what is depletion? So these are terminologies as an accounting student you must understand. Now, what are these? Simple. Depreciation is simply the allocation of the cost of an asset over its economic useful life, but depreciation relates to tangible non-current assets. So property, plant, and equipment, tangible non-current asset, depreciation. Amortization is the same thing, the allocation of the cost over the economic useful life of the asset, but amortization relates to intangible assets. So we amortize the cost of intangible assets, we depreciate the cost of tangible non-current assets. Now, these are KG2 things. Like, these are things that if you sleep and wake up and you are asked, you cannot say, like, you just go straight and hit it because, I mean, you know it. So intangible assets like patent, right? Copyright, franchise, we amortize them. Impairment. Now, there's an accounting standard related to that. We'll come to that in a moment. But impairment refers to where the recoverable amount of an asset is higher than the carrying amount of the asset. So maybe the entity is carrying the asset in its books at, say, 50,000. But the recoverable amount of the asset is, say, 70,000 or something like that. Okay, then the asset hasn't suffered an impairment. But if scenario number 2, the entity is carrying the asset as, say, so let me take that again because I made a mistake. Impairment is where the carrying amount of an asset is greater than the recoverable amount. Okay, so the carrying amount is greater than the recoverable amount. What does that mean? It means the entity is carrying the asset above or higher than how much the asset is actually worth. So that is an impairment. Now, impairment can be an individual asset or it can be a cash generating unit, which is a whole business group of assets and all other things. Depletion is the loss in value of an asset as a result of wear and tear, time, obsolescence, usage, and those things. That is what we mean by depletion. And so these terminologies sometimes are used interchangeably. But as a financial reporting student, corporate reporting student, and public sector accounting student, because these things are equally in public sector, you must know how and when these principles or terminologies apply. Okay. So if that is the case, we can carry the asset at the fair value, recoverable, revalued amount, or the cost model. But here is the deal. On the subsequent measurement of the asset also, of tangible assets, PPE, there are some other accounting standards that are going to be coming to town that you must be mindful of. The first one is what I mentioned earlier, IAS 36, impairment. Because yes, assets may suffer impairment. And so we must account for it. Number 2, IAS 12, income tax. There are going to be deferred tax implication issues in IAS 16, property, plant, and equipment. So if you say, hey, I understand IAS 16, my question then will be, okay, what if an entity revalue assets and there is a deferred tax implication? How do you account for that? Deferred tax? No, but that is IAS 12 for now. It's not IAS 16. No, sister, it's a combination. Okay, it's a combination. So we could have a question where the entity has revalued the assets and the revaluation has resulted into a deferred tax implication. So how do we account for deferred tax when there is revaluation of assets? IAS 12 is coming to town. So again, you don't just say, I understand IAS 12. Sister, do you understand IAS 12 in light of revaluation of assets, and there is deferred tax implication. Do you understand that? You have to know that. So IAS 36 is going to be there. IAS 12 is going to be there in respect of that. Then we're going to have what I refer to as transfers on subsequent measurement. You see, sometimes an entity has maybe an asset, right? Then it's like, oh, maybe the office space is too big. So they're going to sublet some of the part of the office space. Okay. If you are going to be subletting part of the office space, that means that we are moving from property, plant, and equipment into an investment property, IP. So how do we account for that transaction? So from the beginning of the year that we acquired the asset up to the date that we decided to now rent that asset, we are going to apply IAS 16. From the day that we now start renting that asset, we are now going to apply IAS 40, investment property. So you must know how to do the accounting. So the examiner can bring a question up where you would have to apply IAS 16 and IAS 40 in that given question. The question is, can you do it? We can do the reverse of the above. That is investment property. The entity is renting the property out. Then it says, now we want to use the property for the day-to-day running of the organization. So how do we move from IAS 40 into IAS 16? What are the rules? Or number 3, the entity will be using the asset for the day-to-day running. The management will say, Charlie, we want to sell this asset now. Okay. So we are transferring from PPE into a non-current asset held for sale. So that is IAS 16 into IFRS 5, non-current asset held for sale and discontinued operation. What are the principles there? So again, you were just on IAS 16. But look at the stories we are telling. Look at the way we are dancing. Look at the fun we are having. It's not fun, right? But it's fun. That is the beauty of the accounting standards. So if we narrow things down and you look at the accounting standards like this and the way they are intertwined, look at something. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, plus this, 10 standards. 10. And whether you like it or not, financial reporting, corporate reporting students, you must understand this. Now, in public sector accounting and finance, all these standards are there, but flipped differently. And that is why we recommend that you write the public sector accounting and finance and public sector together. Public sector accounting and finance and financial reporting together. So, for instance, if you take something like, let's have PSA here, let's have FR there. So now get a relationship. Get a relationship because everything I'm talking about here can be connected in public sector, because in public sector, we will have a dedicated question on the IPSAS. Okay? In public sector, we are dealing with IPSAS. In financial reporting, we are dealing with the IFRS. So everything I'm saying here can be applied in the public sector class under the accounting standards. The deal is simple. So for instance, we're going to have IPSAS 17. That's IAS 16. We're going to have IPSAS 16. That is IAS 40, investment property. Okay? We're going to have IPSAS 4, event after the reporting period, and that is IAS 10. We're going to have IPSAS 5. I think IPSAS 5 is it borrowing cost or effect of changes in exchange rate? Give me a sec, so I don't give you bomb. Yeah, borrowing cost. So IPSAS 5 is borrowing cost, and that is IAS 5. Sure, me say IAS 5. IAS 23, borrowing cost. Then IPSAS, give me a sec, I'm confirming IPSAS 4, whether it's events. No, IPSAS 4 rather is effects of changes in exchange rate. Give me a sec. Let me make sure I'm not bombing you. Okay, so IAS 21, effects of changes in exchange rate. Okay, making sure that we have the right thing there. Give me a sec. I want to pull up my IPSAS here so that I can draw some few parallel and then we go. All right, so IPSAS 14 is the same as IAS 10. Okay. Then let me add the last one. Then I can go. Then we will have IAS 19. That is the same as IPSAS 39. That's just an example of what we are trying to do here. So something like IPSAS 19 provisions is the same as IAS 39, sorry. Provisions, contingent liabilities, contingent assets. All right? So that's the relationship. And so that is the beauty of doing financial reporting or public sector and corporate reporting together. Why? Because it affords you the luxury that, okay, if I'm learning this, then it's going to apply the same thing in the public sector. The only thing is that in the public sector, there's just some few terminologies that are going to be changing a little bit because we are in the public sector. So there's a little distinction, but 98% of the time, the law is the law is the law, the rule is the rule is the rule. But that is what you must understand when it comes to the accounting standard. So now, IAS 16 alone, looking at the intertwined relationship, we've covered 10 accounting standards. And you are not just covering 10 accounting standards out of luxury, but you are covering it because of the way they are connected. So I am seeing these 10 accounting standards as one. Why? Because they are applicable and connected to IAS 16. So you cannot say, oh, I have finished learning IAS 23. Hello? I have finished learning IAS 16. Okay, if you have finished learning IAS 16, have you connected it with the other 9 accounting standards? If you have not connected it with the 9 accounting standards, then you are not done with IAS 16. You cannot say you are done with IAS 16. But that is the starting point of the standards and the various things that you must understand. If there are any questions, please put it in the comment section, because if there is any follow-up, something you didn't capture well, you put it in the comment section or the chat for me in respect of that. I'm seeing some chats coming in from YouTube here. I don't know if I can look at this. Give me a sec. Why am I not having my text properly done? Is it level 1? No, this is level 2. Who is this? Bra said, "Sir, your mentorship is so amazing. I got a FRO. Solve the theory first to get time to relax your mind for the difficult ones. God bless you." Congratulations for getting FR, and I hope that you are preparing for your next papers coming July 2026. So that's IAS 16 and its connections. But there are some other accounting standards that you must also understand. And I call this one the 3, wise men. Okay, so the 3 wise IFRSs. And that is this guy, IFRS 15, revenue from contract with customers. IFRS 16, leases. And then financial instruments. Now, financial instrument has 3 accounting standards that you must be mindful of. So we have IFRS 9, and that is financial instrument recognition and measurement. Then we have IAS 32, and that is financial instrument presentation. Then we have IFRS 7, and that is financial instrument disclosures. So financial instrument has 3 different accounting standards. And in a given question, the examiner can get goosebumps and bring whichever he wants. Okay? So when you're dealing with something like convertible loan notes, that is where you use the IAS 32, financial instrument presentation, and and if the entity is the one issuing the convertible loan note, then it will classify the convertible loan note into, or we categorize it into debt and then equity in respect of that. Then if we are dealing with IFRS 2, share-based payment, and the third party has a right to take either shares or cash, then it is a compound financial instrument and must be accounted for in accordance with IAS 32. Do you get the idea? So it tells you that there is financial instrument in IFRS 2, share-based payment, which is corporate reporting, student, your dance floor. So these 3 standards work together, and you must understand them. Before you head into the exam hall, you must understand it. Now, the reason why they are connected is because the person connecting them, or the standard connecting them, is this guy, IFRS 16, leases. Especially when we are dealing with sale and leaseback transaction. So when an entity sells its asset and leases back the asset, then 2 things could happen. Because, you remember last year, I think so, when the president, the Bank of Ghana, the Bank of Ghana was rammed into the ground, and at a point they were having negative equity at the end of the day, and they needed money. And the Minister of Finance was like, I'm not giving you any money. If you need money, you people should, sell and lease back your head office, because that new head office that you've built is a nice building. Maybe there are some entities that will be willing to, enter into a contract with you. So you could do sale and lease back. So if you do sale and lease back, then 2 things could happen. Either the performance obligation has been satisfied, or performance obligation has not been satisfied. When we say performance obligation has been satisfied in accordance with IFRS 15, it means that we have sold the building. We have sold the property. If yes, performance obligation has been satisfied and we have really sold the property, then the transaction is a sale. If it is a sale, then we're going to be applying lessor accounting in accordance with IFRS 16. But if the transaction is not a sale, so although we've entered a sale and leaseback transaction with the party, with a third person, but then performance obligation has not been satisfied. In other words, we haven't transferred risks and rewards. We haven't transferred control to that third party. Then the transaction is not a sale. Instead, it is a financial arrangement. If it is a financial arrangement, then it must be accounted for in accordance with IFRS 9, financial instruments recognition and measurement. Because it means that the asset was used as a collateral facility. So you don't say you've sold it. Instead, it was used as a collateral facility. The same thing happens to even inventory. So the entity can sell goods. So let's say that Kukua sold goods to Ohima under or with a right to buy it back at some time in the future. Okay. If they sold the goods with a right to buy it back, then they didn't sell goods. So the proceeds they got from Ohima, the proceeds Kukua got from Ohima, cannot be included in their sales. because it's not a sale. They will buy it back. So what is it? It is a financial arrangement. And the inventories were used as a collateral facility. So in the books of Kukua, we have to recognize financial liability, a loan from Ohima Limited. Then the inventories, which is in the books, which may still be with Ohima, will be recognized as part of the closing inventory of Kukua at the end of the year. That is where these standards are merging. So these standards merge in IFRS 16, sale and leaseback. They also merge when we sell goods with a repurchase option, which means performance obligation has not been satisfied. So in that case, the transaction is not a sale. And so these three standards are critical accounting standards that you must understand before you go into the exam hall. For financial reporting students, this can be in a footnote to the final accounts that you are going to be preparing. All right, can be in the footnote to the final account that you're going to be preparing. And you must have the knowledge to be able to account for it, that, hey, the transaction is not a sale, but it's a financial arrangement. If it is not a sale and it's a financial arrangement, how can I account for it? And you must know how it should be accounted for generally at the end of the day. And that's what you must understand generally. So these three standards are the next collection. Then we have all of the other standards that you need to be mindful of. Okay, so we have the others coming up, like IAS 10, IAS 2, IAS 33, earnings per share. Okay. IAS 24, related party transactions. All of these are standards that you must understand, that you must be mindful of. IAS 38, intangible assets. You must understand them, and some few other standards. So if you look at it this way, now, technically, you realized earlier that I referred to IAS 2 because it has connection with other accounting standards. It has connection with IFRS 15. It has connection with IAS 16. So it's not on its own. Okay? IAS 10 events after the reporting period also has a connection with IAS 38. IAS 37, rather. Provisions, contingent liability, contingent assets. IAS 10 has a connection with that. So you must make sure you understand how that connection really works generally at the end of the day. IAS 38, intangible assets, a crucial accounting standard that you must know about and has some relationship with impairment, IAS 36. And you must also take your knowledge from IAS 16 here. So IAS 16 knowledge will be applying to the IAS 38 as well. So again, IAS 38 is not on its own. When you come to IAS 38, the knowledge you had from IAS 16 will be carried forward. The knowledge you had in IAS 36 will be applicable because intangible assets equally suffer impairment. And that's what you must understand. So this is the breakdown of the accounting standards. Yes, independently, you can list 18 and 19. 20 standards. Oh, how can I know all of these standards? No, mom. No, sister. You are not supposed to see them independently. You are supposed to see them in that cluster that they are in and how they connect with each other. And that is the beauty of the standards. Even IAS 33, when you get to diluted earnings per share, you realize that some knowledge are going to be coming in from IFRS 9 and IFRS 2, share-based payment and share, and then financial instruments when you get to diluted earnings per share. So each of the standards, all I'm trying to tell you is this, that yes, we could refer to the standards independently and give a tall list of the standards. But if you look at them in the light of the way they are and learn them in that manner throughout the next 12 weeks, really, you realize that it's very easy. It's very, 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 very easy. Easy peasy. I can guarantee you that at the end of the day. And that's what you need to understand generally when it comes to the accounting standards. And then most importantly, how the accounting standards are also reflected in the public sector examination. So again, that's why we said financial reporting and public sector, the relationship. Because majority of the standards that you are going to be learning in financial reporting, when it comes in public sector, is the same thing, only that the context, the structuring, because you are in public sector, will be a little bit different. But the law is the law, is the law, irrespective of where you are. The principle is the principle, irrespective of where you are. And that's what you must understand about the accounting standards. Why am I saying all of these? Because in your financial reporting examination, you have 45% application of standards specifically, directly. Because you have question 2, standards. Question 3, the single entity financial statement, you have to apply accounting standards. And then the theory in question 5, you could have maybe B or C of that being an accounting standard. So that is a standalone application. Remember, we've not come to consolidation yet, because in consolidation, there are accounting standards here. So in question 1, consolidation, there are standards you need to apply. All of these standards, some of them can be applied in question 4, which is the evaluation of financial statements. That is why we are saying this. For corporate reporting students, you are even in a bigger hole, because you are going to be having directly the standards coming in standalone to be 30%. And that is question 2 and question 3A. That's 30% of the question standards. But here's the beauty. When it comes to the the specialized transactions, okay? When it comes to the specialized transactions, which is either business valuation or financial reconstruction, the standards are going to be following you there. And that is 15%. Then certainly you come to consolidation, then you come to the theory. So it tells you that if you can be strong in the standards, you will be good to pass the examination. Then in public sector, as I mentioned earlier, question 2 in public sector, 20 marks IPSAS. Then the question 1, financial statement preparation, IPSAS. Because there you are going to be applying the IPSAS, the Public Financial Management Act 2016 Act 921, the Chart of Government Accounts, the Financial Administration Act. But primarily, you are going to be calling more on the IPSAS, because we use the IPSAS in the preparation and presentation of financial statements in the public sector. So that is a standalone 40 marks in public sector accounting and finance that relates to the IPSAS. So please, I don't want you to, just jump and start doing things you're not supposed to be doing. Hey, Charlie, I'm doing ratio analysis. Hey, Charlie, I'm doing consolidation. No. Before you get to ratio and consolidation, ask yourself, am I okay with these standards? How strong am I? Because in consolidation, dealing with even fair value of consideration transferred, these standards will follow you there. Because there is issue of loan notes. That is IFRS 9. How do you account for it? There is deferred consideration and contingent consideration. That is IAS 37. How do you account for it? Then we could have issues in respect of maybe changes in asset. That's IAS 16. How do you account for that? So the standards are following you right there. Then goodwill and how you deal with impairment in goodwill. IAS 38, IAS 37. Sorry, IAS 36, IAS 38. Then you go to fair value adjustment. Okay, when it comes to fair value adjustment, how do you do the treatment? It will be based on an accounting standard. So you can't jump and say, I'm going to do consolidation when you don't understand these accounting standards, when you're not formidable, because the consolidation will just be a headache for you. But if you get this here, then when you get to consolidation and we sprinkle the little ones contextualized in consolidation, then you can excel in this part because you understand the accounting standards. And this is the pillar that holds financial reporting, corporate reporting, and then the public sector 40 marks coming in the exam hall. And if you can see the accounting standards like this and study them like this, and looking at the relationship that we've drawn, the correlations we've drawn between the standards, among the standards, I can guarantee you'll be in a better position to go into the exam hall, write the exam with confidence, and pass the examination at the end of the day. So that's all. That's all. Because once you are strong in the standards, you can do single entity easily. Okay, preparing P&L and statement of financial position, it's easy. Oh, cash flow statement preparation, it's easy. You can prepare a cash flow statement if you can deal with the adjustments. You can prepare statement of P&L and OCI and statement of financial position, statement of changes in equity, if you understand the standards, because each of the footnotes will be an accounting standard. So if we are doing statement of profit or loss and statement of financial position, you may be calling on IAS 16. That one is done deal waiting for you. You may be calling on IAS 12. It's done deal waiting for you. You may be calling on IAS 38. You may be calling even on IFRS 15 because they are constructing something in respect of that. You may be calling on IFRS 9, financial instrument. You may even be calling on IAS 33 here, earnings per share calculation. So each of the footnotes will be an accounting standard. So if you know the accounting standard, you can do single entity easily. That's all we are saying here. If you know the accounting standards, consolidation will be easy for you. Because you know how to calculate fair value of consideration transferred. If they do a share exchange, you will know how to account for it. If they do deferred consideration, you will know how to account for it. If they do deferred consideration, you will know how to account for it. If they do issue of loan note, you will know how to account for it. Why? Because the standards would have prepared you, and when you get there, no problemo. When there is fair value adjustment, you will know how it's supposed to be dealt with. Why? Because the standards has worked for you. So once you are good with the accounting standards, everywhere is going to be good for you when it comes to dealing with the financial reporting and corporate reporting. And that is what you must understand about financial reporting and corporate reporting. The standards. The standards. The standards. And that is why our key summary videos, financial reporting, corporate reporting, comprehensively cover all these standards. Comprehensively. So in the key summary videos, you see videos broken down for the various accounting standards to help you to walk through the principles very well. Once you get the principles, you can then use the practice questions, either the live practice question or the practice question courses, to now start solving questions, to make sure you apply the principles very well. Because it's one thing to say, yeah, I know the standards. It's another thing to be able to apply the standards to a specific question. That's the thing. So the question is, can you apply them? But that's the idea. If you can do this, corporate reporting, financial reporting, it'll be easy. Because business valuation, the concept is there. But before you arrive at valuing the business, you must do some adjustments. The adjustments you will do are based on the accounting standards. Financial reconstruction, corporate reorganization. Okay, it's easy. we can do a reconstruction, but there could be transactions in there that are accounting standards related. How do you account for it? We will revalue assets. How do we treat that? They will enter some transactions based on the standards. How do you account for it? So the other topics, evaluation of financial statements, no problemo. Yeah, we can quote the formulas, but if we are supposed to have an adjustment to the financial statement before we do the calculation, the adjustment to the financial statement will be based on the accounting standards. So if you are not strong in the accounting standards, then the ratio, the formulas that you've chewed on the ratios will just be au revoir mon ami. And you get 0. Not because the ratio question was difficult, it's because your fundamentals are weak. Because if the fundamentals are weak, the question will expose you. Do you get it? If your fundamentals are weak, the exchange rate will expose you. Then you now come back and say, if somebody say that the exchange rate will expose you, it's a warp logic. I'm like, oh, bro, what kind of ideology is that? That's just by the way. So that's financial reporting, corporate reporting in respect of that. I'm seeing a chat coming up. Let's see if I can take it. Let's see. Nhyira, good evening. I know I have missed a lot, but I hope I can get the playback. Yes, you can get a playback on on YouTube. The link will be shared, so you can watch the playback. So that is financial reporting, corporate reporting. Now, we've done a little on public sector, so I'm just going to be crystallizing a little bit on public sector for you as we narrow down our discussion on public sector as well. So when it comes to public sector, as I mentioned, in public sector accounting and finance, we are going to be dealing with ministries, departments, agencies, central government, and then metropolitan, municipal, and district assemblies, the local government. So in the question 1, financial statement preparation, the question can be on the central government perspective or the local government perspective or a covered entity perspective. And that is where revenue management and expenditure control comes in. That is where the IPSAS comes in. So you must know the revenue sources to various covered entities as well as to the central government. And most importantly, how those revenues must be accounted for in the books of the entity. But if you remember in the previous session yesterday, we mentioned that the Public Financial Management Act 2016, Act 921, is an anchored act that a lot of the things that we are going to be discussing will be coming from there. I believe that you have downloaded it, and it's a document that will be part of your arsenal generally in that particular case. So that's what you must understand there. Then we mention a couple of things, very important. The Treasury single account. We're going to be getting into this later on in the public sector class, but it's important. We're going to be looking at the consolidated fund, budget preparation, a key 10 marks area waiting for us in the exam hall. Then public debt management. This is part of the key issue as well. It's a 3 to 5 mark question that the examiner can access, and we're going to be discussing that as well as we continue with the discussion in respect of that. Then another key area in public sector is PIFA. That is Public Expenditure and Financial Accountability Framework. It is a framework that is used to assess the strengths and weaknesses, the efficiency and inefficiencies in the public financial management system of the government. And there are 7 key pillars that we are going to be using to analyze that. And that is also another 10 marks area coming in the exam or when it comes to public sector. So the 7 pillars include budget reliability, transparency, policy-based budgeting, assets or liability management, then issues in respect of execution, accountability and reporting, then external scrutiny. And we're going to be coming into all of these. So these are the 7 pillars. And to evaluate, we are going to be using either the weakest link, M1, or the average method, M2, to do the analysis and to do the evaluation and then the interpretation. There is a way the weakest link is used. There is a way the average method is used. Now remember, by the time you are coming to PIFA, you have done a number of the issues in the IPSAS and the revenue management and revenue and expenditure management, and that has prepared you so that when you get here, when you do the analysis and calculate and interpret, you can make recommendation because you have a deeper understanding on what is supposed to be done. Then ratio analysis or evaluation of financial statement in the public sector. In the public sector, there are 3 methods that we use to evaluate the performance of the government. One of them will be in the exam hall. We have the common size analysis. We have the ratio analysis. And then we have the budget variance analysis. Now, the ratio analysis, some of the indicators are the same thing in the financial reporting class. So in the financial reporting, you're going to be doing liquidity ratios and some of those profitability ratios, working capital ratios. In the public sector, partly, some of the ratios are there. But then exclusively in the public sector also, there are some other ones that are not in the private sector, but they are exclusive here, like goods or services to total IGF, which is measuring how much of the internally generated fund that a covered entity spent on financing its goods and services. That is the day-to-day running of the entity. So how much of their internally generated fund are they spending on goods and services? Then government of Ghana grants per capital, right? So the government grants per capital, goods and services per capital. So the value of goods and services, if we share it among the citizens, how much is everybody getting at the end of the day, and some other ratios that you need to be mindful of in respect of that. So in the public sector also, what are we looking at? The IPSAS as connected and linked with the financial reporting, then the PIFA, then budgeting, then evaluation of financial statement. Pretty cool. Then certainly some key introductory issues that we're going to be talking about, right? Like that, and those things, majority of them will come in the Public Financial Management Act 2016, Act 921, as we mentioned earlier. For instance, the role of key public officers, Minister of Finance, Parliament, Public Accounts Committee, Auditor General, Controller Accountant General, Principal Spending Officer, Principal Account Holder, SIGA, the State Interest and Governance Authority. What are their roles? Okay, those things are going to be there. Users of public sector financial information, all of those introductory issues, accounting basis, accounting techniques. So accounting basis, we are talking about cash accounting, accrual accounting, modified cash, modified accrual. Then we come to issue in respect of the accounting techniques. And that is where we are talking about vote accounting, commitment accounting, fund accounting, environmental accounting. So all of those issues are introductory discussions that are going to be setting the tone for us. Then you zoom in into IPSAS, you coming into PIFA, you coming into budget, you coming into evaluation of financial statement, and boom, you're going to be good at the end of the day. So when it comes to public sector accounting and finance also, these are the things that you must understand. Any other questions for me? Any other questions for me? Any other questions for me? Let me see if I have this up here. Any other questions for me? Let's see. Okay. So these are the issues that you must understand when it comes to financial reporting, corporate reporting, and then public sector accounting and finance. Again, it's not difficult. But everything that I have done, you need to see it the way it is connected practically. Because what we have done is the compressed version of everything in the syllabus. But the question is, how do you see these out gradually? That is what we are going to be doing over the next 12 weeks. We're going to be trying as much as possible, walking you through as many of the standards as possible. As I mentioned yesterday, certainly time will not permit us to exhaustively cover all the accounting standards. But certainly, we are going to be doing about upward of 90% of the standards. So you're going to be seeing it at play. Then you're going to go to single entity. You're going to go to ratios. Then we're going to clean it up lastly on consolidated financial statement. When it comes to public sector, similar idea. We're going to be starting with those introductory issues. The IPSAS will come in naturally. Then PIFA will come in naturally. Evaluation of financial statements will come in naturally. Then budgeting will be the last thing we will do also in the public sector accounting and finance. But in the next 12 weeks, we are going to be taking this and breaking it down, starting from Monday as we begin our live lectures for the July 2026 examination. So again, leverage the key summary videos in the mobile application, okay, that you can get in the Google Play Store or the Apple App Store for those of you who have enrolled in the course, and start walking the journey through. I believe all other things being equal by now. You've watched the course overview, you've watched the study plan, and you are putting together your study plan to start using it after the Easter break. Definitely from tomorrow, some of you are going to be chilling and having a lot of fun, which is equally important because, what the heck? You got to chill a little. But at the end of the day, we're going to be continuing and then seeing what we can do in the next 12 weeks. If you have not enrolled yet, you can send us a message on WhatsApp and then complete your enrollment and start studying, because our live lectures will be starting on Monday. Public sector, taxation, man accounting, financial management, audit, financial reporting, strategic case study, corporate reporting. All of the papers in respect of that. So complete your enrollment and then join us to study under my mentorship. Let me hold your hand, provide you with the assistance that you need. Our content, our mentorship, our one-on-one sessions, all of these are designed to make sure that we put you in a position to go into the exam hall, write the exam with confidence, and pass the examination. So I'm going to wrap it up around here today and wishing you the best for the Easter holidays, starting from tomorrow throughout Monday. Monday is a holiday, but per our timetable, we are going to be having lectures on holidays. So Monday we'll still be having lectures for the public sector. So you take note of that because it's indicated on your timetable. So that's it about that. Have a great weekend. Make sure you take good care of yourself. Have fun. Chill as much as possible, because after that, you're going to be spending a lot of time. No more chilling until the exam. All right? So that's it about that, and I'll see you on the next one as we continue with our discussion.